Good evening, everyone. Thanks for joining on a Saturday evening. So before we start the session, a quick disclaimer, right? We all understand that every investment comes with a risk, right? If stocks or options or crypto futures or buying gold or right, whatever we do, everything has its own advantages, disadvantages. So we need to understand before investing our money, we need to understand whether we have that risk tolerance or not, and then only, right, if we think we are okay, then only we need to invest into these type of vehicles. So again, this session is to give an overview about options, and then also explain you about how algo trading will help us, and we are working on integrating with mirror trading and all those things. So the testing is in progress. So I'll be explaining all those concepts. So, and also I'll explain how to interpret. Currently in the option channel, we have multiple endless, how to interpret their alerts and how to buy, sell, all those things. So we'll be doing it in next 1 to 1.5 hours. And I'll make sure that the time you spend here is worth it, and that you will learn some new concepts, new techniques, new tips, which will help you in your regular trading. So, right. So let's start with what is an option. Right? Many of us know about stocks, right? Stocks is nothing but we are getting an ownership in a company, a minor ownership. It can be point, not one or so. But many of us may not know much about options. Option is nothing but an agreement or contract between a buyer and seller. So just like, for example, if we are buying a home, we will get into an agreement with the buyer, right? If we are buying a home, we'll get into an agreement with the seller. In the same way, option is also just like an agreement. So we are getting into an agreement with either a buyer or seller. So just remember that it is just like a contract or an agreement between two parties. So what that agreement will do, it will give the buyer a right. Right? If I am buying a call option or if I am buying a put option, it will give me a right, but there is no obligation. I don't have any obligation. If I don't want to buy those stocks at that price, I can just leave that. There is no obligation as a buyer, but as a seller has an obligation, right? The buyer, he has a right, but there is no obligation to buy or sell a certain asset at a specific price at any time during the life of the contract. But seller has an obligation. Buyer only has a right, there is no obligation. But seller, whoever is selling that contract, selling that agreement, he has an obligation to fulfill that contract. We'll go example, right? We'll see with some examples so that you will understand. We'll come back to this definition later after looking at some examples, right? Some real-time examples. We'll also look at some examples with taking an actual option contract. Why investors, or why do we like to trade options, right? Or what are the main reasons to use these options as an investing strategy? Or so there are two main reasons. One is speculation. For example, if somebody is speculating that this chip bill has passed, Nvidia or AMD or Qualcomm, that some of these chip companies might go further. So you might be guessing that that bill will help Nvidia to grow much more or AMD to go much more. So we are speculating. We are guessing that these particular stocks might go up huge. That is one reason where we are speculating that something can happen. It can be bullish or it can be bearish, right? Bullish means you are assuming or you are guessing that stock price will go up. Bearish means you are expecting that stock price will go down. So either if you are positive that price will go up, you can buy a call agreement. If you think that stock will go down, then also you can make money by buying a put agreement or put contract. In both the ways, if you are speculating something and it happens within the time frame, then you can make huge money. You can make 100%, 200%, 500% based on how that stock moves. You can make huge money with a low investment, right? We'll take some examples. For example, Tesla stock, right? Tesla stock is around $890 now. If you want to buy a stock, for example, you are bullish, you think that Tesla will go more in the next week. It may go to 900, 950 or something. So if you invest $890, let us say it is moving to 950, that is a $60 increase in the stock price. So what is your return of investment? Maybe 7 to 8%. But everybody may not have a big portfolio to buy 100 Tesla stocks or 200 Tesla stocks or 50 Tesla stocks. But instead of buying a stock, you are expecting, right? You have some strong conviction that the stock price will go up, but you don't have a huge capital, right? Whether based on the news, based on the technical analysis, or whatever is the reason, you have a strong conviction that particular stock will move up, or Costco will go up next week, or Tesla will go up next week, or right? There are many stocks. Netflix may go up next week, or AMD, Nvidia may go up next week, but you don't have a bigger account or lot of money to invest into stocks, right? Then instead of buying the actual stock, you are buying a call agreement, right? A call contract saying, like, for example, if Tesla is 800, you may buy a call for 810, or you may buy a call for 820. That means you are paying some premium to the seller, and you are telling him that even Tesla goes to 850, you have to sell me the stocks at $820, because you are buying a 820 call contract. You are telling to the person, the seller, somebody is bearish. Somebody thinks that, oh, last week whatever happened was just a temporary bounce. Again, Tesla will go down next week. He is bearish, whereas you are bullish. He is selling that contract, assuming that Tesla will go down. You are buying the contract because you have a strong conviction that Tesla will go up. So even Tesla goes to $900, he has to sell the stock at $820 to you, right? That is right. A quick example. We'll go further with some real-time examples, so you can remember these concepts forever, right? But why do we get these option contracts when you want to? When you don't have a huge capital, you don't want to block all your money in stocks. You want to just with a maybe 1%, instead of putting 100% on a stock, maybe with 1% of that amount, you want to speculate that it will go up or it will go down. And if it happens based on your prediction, you can make huge money. On the same day, you may make huge money, or within the time frame, if it doesn't happen, that entire money also can become zero. So you are speculating, you are guessing, you are predicting something will happen. If it happens, you make a lot of money. If it doesn't, that entire money will become zero, right? Whereas in a stock, there is no time period, right? For example, you bought Tesla stock, assuming that it will go up by another $50 next week. For example, it is not going up, it remains at the same price. You can just hold it, maybe another 1 month or 2 months, it may reach your target. So that is the advantage with stock, but disadvantage is you have to put a lot of money. Your money is, right, basically stuck. You have to wait for it to reach to the targets. Good thing is it doesn't become, the value may decrease a little or to some extent, but it won't become zero. Whereas the options, you have a time period. Maybe if you're buying a weekly contract or monthly contract or whatever it is, based on the premium you are paying, based on the contract which you are selecting, you have up to a certain period where if it happens based on your prediction, you make a lot of money. If it doesn't, you may lose that entire premium what you paid, right? The other advantage or the other reason generally we get option contracts is to hedge our portfolio, right? You may have a lot of stocks in your account, right? You are worried that recession may happen, or right, recession already started, it might, all stocks might go down. So you want to, just like, right, when you buy a house, we take a house insurance. When you buy a car, you take a car insurance. When you buy a phone, you take a mobile phone insurance. In the same way, you can hedge your account. You can protect your account by buying some insurance, right? Just like life insurance, home insurance. You are paying some premium, and then even if that stock price goes down, you are protecting it. You paid some additional money, but that person will pay you. Even though stock price goes down, he will still buy the stocks at a higher price from you, right? So one is speculation. The second reason is hedging your portfolio. You want to hedge, you want to protect your portfolio. So again, as I mentioned, an option contract gives owners to purchase, right, a call option or sell an asset, right? So basically there are two types of option contracts, right? We already discussed it is just an agreement between a buyer and seller. But what type? There are two types of agreements we can make. One is a call option, second is a put option. Let us take one real-time example. Most of you can, right, correlate with a real-time example, and then we will look into how these option contracts work in the real time, right? Let us take some simple example. Most of you, right, because stock market is going down, many of us want to invest into real estate, right? And especially Austin and right, Dallas, there is a huge right upward. There is a growth in real estate prices, and many of us are right going behind real estate investments. So let us take a simple real estate investment example to understand more about what is a call option. What is a call option agreement? So here we have two parties. Susie, right, starts with S. That means Susie is a seller and Sammy is a buyer, right? So Susie, she has a home in Austin, and as of now, she kept that home on sale for a 500,000. And Sammy is her friend or relative, or right, somebody who knows Susie. Let us assume that Sammy is going to Susie and he doesn't have that 500,000 immediately. So he is going to her and telling her, can you, right, I like your home, right? I visited your home many times. I like your home, because he thinks, right, Austin market is very hot. This price might go up to 600, 700K within few months, or right, within a year or so. So he wants to buy that home, but he doesn't have all that money with him. So what he is doing? He is going to Susie. It is like an earnest money, but it is not like a deposit, right? He's paying some premium. He is telling to Susie that I will pay you $5,000, but don't sell this property to anyone until next 3 months, right? If I come with that 500, right, in addition to this 5,000, if I come to you with that 500K within the next 3 months, you have to sell the property to me. If I cannot bring that $500,000, this 5,000 is yours, right? Just like when we get into a real estate agreement, we pay earnest money, right? You pay 1% of the home or the land value. So if you complete the contract within the period, then that, right? So you by paying that earnest money, you are getting some period to apply for your loan and all those things. But here, right, in real estate transaction, earnest is also part of your sales amount, whereas here the premium is right, non-refundable. You are basically paying the premium. So Susie thinks that, oh, already, right, real estate market is at peak. She is assuming in her mind that the property value may go down or something. So she thinks, right, okay, if he's paying me 5,000 and he's ready to buy this property with 500,000, so I'm getting another $5,000 extra, which is like, right, if she rents a property, she may get $1,500 per month. Just like she's getting that $5,000 extra, so she is accepting that agreement, right? There is a contract between Susie and Sammy. Susie is the seller and Sammy is a buyer. Sammy is paying a premium to Susie and telling her, if I come within next 3 months with the $500,000, you have an obligation to sell the home to me. Within these 3 months, you should not sell it to anyone else. But as a buyer, he has a right, right? He has a right to buy it, but he has no obligation. If he don't want to buy it in the next 3 months, for example, property goes down, or he may not say, get the money within that time, he has no obligation. Only loss for him is $5,000. Whereas Susie has an obligation to hold the property for next 3 months and sell at that price, whatever they are agreeing, right? I will sell my house for $500,000 within the next 3 months if you come with the cash, or if you come with the money, $500,000. So he is paying 5,000 as a premium amount, right? I hope everyone is clear with that, right? Seller and buyer. Seller has an obligation, whereas Sammy has a right, but there is no obligation here. Let us say, right now he has a right. As a buyer, he has a right. What are the 3 scenarios which can happen in this case? Right? There can be 3 different possibilities. Now he paid that $5,000 to the seller of the house, right? Then now they both agree, they both got into a contract, they both entered into an agreement. There are 3 possibilities which can happen. The first possibility, suddenly, let us say some big company like Tesla or Twitter or some big company announced that, or Samsung, they announced that they will be opening a big factory near to this community, and suddenly that 500,000 home value increased to 600K, right? So that is right. That means Sammy expected that prices will go up. He speculated that prices will go up, and he paid that 5,000 commission for a 500,000 or commission or premium. And now let us say the stock price went up. Just like a stock price went up, here the home price went up. So what is the right? Whether he can buy the home at $500,000 now. So what is the benefit for Sammy here? He just paid $5,000 because he is not having the entire capital. He just paid $500,000, entered into an agreement, and he has a right to buy that property at 500K in the next 3 months. Within a month, the price went up to 600K. So can Susie say that she won't sell the property to him now? Does she has that right? You can put it in the chat window. So suddenly the property from 500K went up to 600K. Do you think she can say that now the price increased, I don't want to sell it to you? Is that a possible option? You can put it in the chat window in the Zoom. So I want to understand whether you are understanding the concept, right? Once you understand the concept, then correlating it with the actual trading makes it easy. So whenever you are buying a call or while buying a put, you can immediately, right, correlate with these examples. You can understand what you are doing, so that it makes you can be more confident when you buy a call or put. Right? You can type in the chat window whether do you think Susie has a right to say that she won't sell the property to Sammy? Do you think she can? Yeah, Pradeep Garu.
I think the chat window is disabled. I think that's why people may not be typing.
Oh, sorry.
Just wanted to let you know. Thanks.
Yeah. Thanks, Amy. Right? Exactly. Yeah. Right. She cannot back out because she has an obligation to sell the property to Sammy, because she already took $5,000. She said that I will hold this property for you for next 3 months. I won't sell it to anyone else. She collected that 5,000 as a premium. So she has an obligation to sell it to Sammy. So for example, you are buying a Tesla 900 contract from Sammy, or right? You are Sammy, Susie is the seller, whoever is selling the contract. You bought a 900 call contract for the next week, next Friday. Suddenly Tesla went to $1,000, right? There is a V-shaped recovery, just like what happened in 2020 after, right after the COVID. Suddenly prices, right, all stocks went down nearly 30-35%. There was a V-shaped recovery. Everything started jumping up like anything, right? If same thing happens, if suddenly Tesla goes to $1,000 by end of next week, you have a right to buy Tesla stock at 900. You might be paying $10 premium, but you have right to buy the Tesla stock at $900 itself. So you are buying a call contract by paying a premium of $10 for coming Friday. Even Tesla stock goes to 1,000, 1,050, you will get Tesla stocks for $900 itself. That means on every stock you are getting $100 to $150 profit, or you can again resell that contract to someone else. You paid $10. When Tesla goes up to 950, suddenly that premium will increase to nearly $50. So if you want to buy Tesla stocks at a cheaper price, you can hold the contract, or you can sell that contract to someone else. You bought it for 10, you will sell the contract to $60 to someone, and he may buy it because he is expecting that Tesla will go to 1,000 or 1,050, like that, right? This is the example where we are buying a call contracts where you are expecting a stock to go up, and even if stock goes so high, whatever you are agreeing, if you are buying a 900 call contract, or Nvidia you are buying a 180 or 185 call contract, AMD you are buying a 90 or 95 contract, whatever is the stock price, you have a right to buy those stocks at that price, whatever you are, right? Whatever is that strike price, whichever call contract you are getting, that is, you have the right to buy those things, right? So here, what is the profit for Sammy in this case? Suddenly price went up to 600,000 within 1 month. Approximately what is the profit for Sammy? So they have an agreement for 500,000, price went up to 600,000, right? Exactly, it is. But he already paid a 5,000 premium, which is not part of the sale price. So his net profit is $95,000, because 5K is just to hold the property. It is not like a deposit amount or something. So his benefit or his profit from this transaction within a month is $95,000. In the same way, if you are buying a call contract and you bought it for $10, you are selling it for 20, there your profit is $10 for on every stock, or right. So, right, this is one possibility, one scenario where generally you are bullish about a stock and the stock price goes up, your premium, either if nobody is buying that, right? For example, you want to sell the contract, but nobody is buying it, then the seller has an obligation to sell the stocks. Even though Tesla moves to 1,000, she has to sell Tesla at $900 to you. That means you are getting it $900, and immediately you can sell in the market for $1,000, right? You may not be able to sell the option agreement, but you will get the stocks and you can sell the stocks in the market, and you can make $100 profit on each and every stock, right? That is one simple example, a positive scenario where you are buying a call, the stock price went up, you can either sell your contract again and make profits, or you can hold the contract, get the stocks, and then sell the stocks in the market, and you can make profits, right? This is one scenario which can happen when you buy a call contract. The second example, right? What else can happen, right? Suddenly some company, right? Some waste management company or someone decided to have their dump yard near to this community, and the price, instead of from $500,000, suddenly price went to $400,000, right? Just like Twitter, we saw that when Elon Musk wanted to buy the company, stock suddenly moved up to nearly 50 plus. When again he said, I don't want because there are a lot of bots, not real users, everything, then suddenly price went down. In the same way, people expected that Twitter will go up, but Twitter went down because of bad news. In the same way, because of uh, some waste management company, right, planning to have open a dump yard near to this home, suddenly price went down to $400,000. So now what is the loss for Sammy in this case? Does Sammy need to buy the stocks at buy the house at 400,000 or 500,000, or his loss is exactly right? Lot of right answers, right? His loss is only 5,000 because he has a right to buy the property, but there is no obligation to buy the property. He has no, as a buyer, I have no obligation. If I don't want to buy, I can say that no, I don't have money, or right, I am not interested now. His loss is only $5,000. It is not $100,000. There is no obligation on him to buy the house at $500,000 as per the agreement. They only agreed that if I come with this cash within next 3 months, I have to get it at 500K. If the price is going down, he can always say that I don't want to buy the property. He can always exit out of the contract. So his loss is only 5K. So as a buyer of a contract, right, you are buying a call option. Stock price, instead of going up, you predicted that it will go up. Suddenly, because again, let us say monkeypox virus cases are increasing, or something else. Again, there is some war between China and Taiwan, or some other FOMC meeting and some rate hikes. Something happened which you never expect, right? Technical analysis, indicators, everything is showing that stock Tesla will go to 1,000. But always this fundamental news, these news events, these war situations, those things can override the technical analysis. Such type of things can suddenly bring the stock prices down, right? Everybody becomes panic. Oh, this new variant is coming up, this new virus is coming up, or this war is going to happen. Russia may put some nuclear bomb on Ukraine or a lot of different countries. Everybody gets panic, everybody starts selling the stocks, and they want to move it to their bank accounts or somewhere which is more safer. Then as demand decreases, the price reduces. So when that happens, you don't need to buy the stock at that price. You can just, your loss is whatever $10 you paid, right? 10 means for one stock, $10. Generally, you buy one contract for 100 stocks. So 10 into 100 is like $1,000 premium you might have paid for the Tesla. That might be only your loss. You don't need to buy the Tesla stock for $900. You only lose the premium which you paid, right? So this is another example. The other example can be, there is no change in the price. Whatever you thought from 500, it will go to 600K. But it stayed at 500K. So what is the, who is benefited here? Is the seller or buyer? Next 3 months, the price stayed at the same price, right? It is like a sideways movement. It is not up, it is not down, right? The seller has the advantage because instead of getting 500K, seller got 505K. Initially 5K as a premium and 500. So if even he is not buying, still the property value is 500K. She already got a 5K, which she don't need to return it back. So seller is at the advantage. So in this case, right, when you buy a call contract, if price increases, you make money. You are at the profitable side. If price decreases, the seller is at the profitable side because she got, right, even the property value decreased, she will keep for some more time and then again property may go up, but she got $5,000 as like, just like she would have given rent to someone, she got that $5,000 as a premium. Or even if it goes sideways also, she can make money, right? Whether if it goes sideways or if it goes down, seller is at advantage. If it goes up, buyer is at an advantage. So when you buy some, right, whom do you want to be? Do you want to be Sammy or do you want to be Susie? Which one do you think is a better scenario? What do you think, right? Do you want to, because right, it is not that in options we have to only buy. You can also sell a contract, you can sell a call agreement, or you can buy a call agreement. You don't need to be, right, don't think that we always need to buy the call contracts and then wait. Only if price goes up we can make money. You can also be a seller, right? Yeah. So what do you think, right? Susie has two chances where she can make money. Sammy has only one out of three possibilities. Whether stock will go up, Sammy is at a benefit. He can make good money. And Susie will be at a loss. But if stock goes down, or stock or the home value remains same, she will be at a profit. She will be at a benefit. So who do you think, as a buyer or seller, who has a better possibility, right? Again, right? I see some of you telling sellers, some of you telling buyers, right? As a buyer, seller, it is right. It is based on the market situation, right? As a buyer, your risk is only premium, right? Your risk is limited. You know how much you can lose, right? It is just like buying a stock, shorting a stock. In the same way, this is a buying a call or selling a call. Even though you have 2 out of 3 chances, but your risk is unlimited, right? For example, Tesla stock, you are thinking that Tesla will go down, and you are selling a contract for $10. You received a premium of $10. Suddenly Tesla goes up, right? Suddenly in last 2 weeks, it went nearly $150 or $130 up from 650 to 890 plus. It went so quickly. Same thing if it happens in next week, right? As a seller, you only got $10, but you are at a big risk of, you have to, right? You are as a seller, you have an obligation to sell Tesla stock at 900, even if it goes to $1,100. That means on every stock you have $200 loss. If it goes to 1,200, you have a $300 loss. If it goes to 1,250, you have three. So the loss can be unlimited. Your account can go right completely zero, or it can be even negative, right? So that's why the risk is more. Even though you have two possibilities, if stock goes down, you make profits, or even if stock remains in sidelines, you can make profit. But the risk is unlimited as a seller. As a buyer, your risk, right? Maximum what I can lose, whatever premium I paid, that is because I don't have any obligation. If stock price goes down, maximum I will lose $1,000 or $100, $200. I know what is my maximum loss. So as a seller, it always makes it complicated, or right, especially market suddenly moving up. If there is a V-shaped recovery, all stocks moving up, then you have a huge unlimited risk as a seller. So that's why generally, right, most of our alerts also generally we try to give on the buy side. That means you are buying a call or buying a put, your risk is limited. Right, so you make money if you buy a call agreement. You make money when stock goes up. Suddenly next day stock goes up, you immediately make money, right? Let us take one example. Right now, I hope everybody understood what is a call option agreement. What, right? Basically here, as a buyer, I don't have any obligation, but I have to right to buy at a certain price. Whereas as a seller, I have an obligation to sell that stock at that price. Let us take some simple example, right? Let me show you the algo which, right, we designed and which is working good. Let us take some example of Tesla. So right, let us say, right, let us just look at a call agreement now. you got some, right, based on various simple moving averages or EMAs or RSI, MACD, various indicators, the algorithm will be looking at hundreds of stocks in the market, right? Whatever stocks we give to the tool, it will be scanning all those stocks, right? If I give Tesla, AMD, NVIDIA, it will be scanning all those stocks. Whenever it thinks like the stock is going to move, it will give a buy signal, right? When I see a buy signal, that means it is giving an indication that this stock, there is a potential that this stock will move up. So at what point it gave a buy signal? On 27th at around $770, it gave a buy signal, right? So then you see, right, it is on 27th July. So it went to nearly $891. So for example, when I get this buy signal, if I buy a $800 contract, or let us say 770, so let us say I'm buying a $780 contract, right, for $5 or something for August 5th expiry. Then that $5 contract, still it is in the upward trend, right? You can see it is above the Ichimoku cloud. It is still moving up. So still there is a possibility that Monday also we can see, right? As of now, there is no downtrend. There is no indication that the stock might go down. So my $5 premium which I paid, or $10 premium which I paid, will be around $150, $160 on Monday morning, right? Because I entered into an agreement with a seller for a $780 contract. The seller thought, oh, right, this moment we know that, right, this is happening since last 6 months. Stock will go up, again it will come down. It will go up, it will come down. It is, right, stocks are choppy since last 6 months. So the seller might be thinking it is just a temporary bounce. But as a buyer, you are thinking that, oh, it seems Tesla will go up. You bought a 780 because it is just at 770. Now you got a buy signal. You are buying a 780 by paying a $5 or $10 premium. And if you are keeping that contract until you see a sell sign, until you receive a sell sign, you are keeping that contract. So that $5, $10 might become $5 means basically $5 for one stock. Generally, we buy one contract means 100 stocks. $5 premium means $500 premium. Your $500 premium might be $1,500 or $2,000 worth now, because you bought a 780. That means you entered into an agreement that whatever is the stock price, you have to sell the stock at 780 to me. That means the person, whoever is the buyer of that contract, he has a right to buy the stocks at 780. So now you want to sell that agreement to someone else, right? Because now that $10 which you, or $100 you invested is nearly $500 now, because the stock price went so high. If you want, you can just keep the contract, wait until the expiry, and then you can receive the stocks at $780 price from that person, whoever sold it to you. Or you can sell that contract to someone else. You bought the contract, again now you are selling it to someone. He will keep it for some time because he is expecting that stock will go to 950 or something. He can sell it to someone else. Like that, you don't need to keep the contract if you don't want to. You can sell it off. So whenever we receive a buy signal, immediately we can buy a closest contract, and everybody's risk appetite is different, right? Somebody cannot sleep when their money is invested into some option contracts. You don't know, next day, suddenly this evening we may receive some news about some other new variant. If you don't want to risk with all those things, if you cannot sleep, you don't want to lose your profits, after some 10%, 15% itself, you can sell it off, right? Everyone has a different risk tolerance, right? Some of you might be okay to lose that $100, right? I think Tesla will go to 900. Let me keep that. I am okay to sell 100. I am okay to lose $100. but I want to get bigger profits. If your risk tolerance, you are okay to lose money, then you have a higher opportunity or higher potential. Or you want to quickly gain the profits. I don't want 100%, 200%, 300%. I am happy with 10%. Within 30 minutes, the premium moved up by 20%. I am okay to sell my $5 at $6, get the profit, and then again look at your work or whatever it is. Right? It is up to you. Everyone is different. So, right? So there is, because nobody knows stock can move to 900 or 950 because, right, this is support. There is a resistance here. Generally, if what should happen is stock should go down here at the resistance level, right? Support means people are buying. Resistance means people generally sell at those levels, right? At this resistance or at this resistance or at this. So, but because the buying volume is huge, more and more people are buying the stock keeps on going up, crossing all the resistance levels, right? No analyst knows whether this can go to 900, 950,000. They only know up to, okay, minimum from here to here, I can give a guarantee, right? Or here to, you bought here, I know it can, there is a possibility, 70, 80% possibility it can go up to here, right? But analysts will not know that this may go up to 870 within 2 days from 770 or 890. So they will basically give a trim. Okay, I am trimming at this point. There is a resistance. The possibility stock can go down here. They may trim some contracts here. So it is up to us based on our risk tolerance. If I am happy with 20%, 25% profit, I can close it here itself. Or I take profit on some of the, if I bought 10 contracts, I will take profit on 5 contracts, keep another 5. Wait for some time. If it is coming down, it is coming down so low, then I will sell the remaining 5. Or if it is going up, at this point, I will sell another 2 contracts. Like that, you can keep booking your profits based on your risk tolerance, right? So let us take, right, the coming Monday, which stocks has a higher potential, right? I can see that DHR, right? DHR is a stock which is approximately $290 plus. You can see that stock is moving up higher and high. So you got a buy here nearly at $270 on 26th. Stock moving up, came down, but there is no sell, right? We are on a 5-minute time frame, because generally for current market, 5 minutes is a better time frame for quick day trading, scalping, or so. Stock is moving up nearly, it went, right, from 270, it went to, right, nearly 291. There is a resistance here. So again, right, based on, if it breaks this resistance on Monday morning, it can go to 300 plus, right? Or if it start coming down, it may come down to approximately 287, or if it comes further down, it may come to 278. Like that, based on the stock movement, you can buy a call or buy a put. So let us take one more example, QCOM, right? There is a sell here, right? Approximately at, it went to $155. There was a sell indicator. It came here and then it started moving up. So it is like a early buy indicator, right? It is showing that the stock might move up. It is an Ichimoku cloud. The stock price is above this. So there is a high possibility that on Monday, we will see a buy indicator on this one, right? Again, QCOM may move to, again, there are, right? I looked at 5-minute time frame, 15-minute, 30-minute, 1 hour, all these time frames, we may get a buy, right? A buy indicator on this, and then it may again move to 154. So whenever I see a buy, I can buy a call contract. For example, if it gives a buy at 146 or something, I may buy for 148 call agreement, or I may buy 150. So if stock keeps on going up, my premium will keep on going up more and more, right? So this is how the algo will be scanning hundreds of stocks. As an analyst, he can look at one chart, two chart, three charts. But an algo is looking at hundreds of stocks and it will be sending alerts, right? For example, right? It will be sending ticker, it will be sending, it is looking at all those stocks and it will send an alert to the Telegram channel saying like, okay, I am buying this stock or I am selling this stock. I am selling this shop at 1025, right? It gave a sell indicator. That means, right, this stock can go down from here. So you buy a put, right? If the stock is going up, if there is a buy indicator, we can buy a call. If there is a sell indicator, you can buy a put, right? It is like reverse. You want to protect your stocks, then you buy a put. You are speculative, you are expecting that stock to go up, you will buy a call. So whenever you see, for example, there is a sell indicator here. Whenever I got a sell indicator at 155 or something, I can immediately buy a put contract, put agreement. That means I am buying an insurance for this stock, saying that I want to buy a 150, 152 put or 154 put. That means even though if stock goes down to 140 or 130, the person, you are paying some premium to that seller, right? Let me show you the slide. So you'll be, so I hope everyone is clear with call, right? Whenever you are bullish, you buy a call agreement. And if that stock price moves up, you can make huge money. In the same way, put option, when you do an option contract in which the buyer has the right to sell a specified quantity of a security, right? You have a right, but no obligation. If you don't want, you don't need to sell it. But if you want, you can sell at that price. So now you are expecting, you have Qualcomm stock at $155. You are expecting that stock might go down. Now you are entering into an agreement, right? Saying that I want to buy a 150 put. So even though stock goes to 130, you have a right to sell at 150. You don't have an obligation, but you have a right to sell at 150, right? For example, your house value is 500K, right? Even though there is some major thunderstorm or major accident or major something happened to your house, you are paying a premium to the home insurance. So you may be paying $1,000 every year or $2,000 every year. If something happens to your home, you have a right to get $500,000 or maybe 450K or 470K based on whatever is your agreement. You have, because you paid a premium to them. They sold a policy to you. They sold an insurance policy to you. You have a right to sell your home at 500K to them. Even though the house value is, because of the thunderstorm, there is a major roof collapsed or something, still the value of the house is only 200K, but because you paid the premium, you have a right to sell that house for 500K to that insurance company, right? Just like car, you have a 50K worth of car, you are paying to Geico or some company. Even though there is an accident, car becomes zero value, that company has to buy that car from you at, right, whatever price you decided or based on the agreements, whatever, right, you based on your contract, they have to buy that car from you at that price. In the same way, put agreement is also same thing. You are buying a put, when you think stock will go down, you are immediately buying insurance to that. Even though the stocks goes down, they have to buy it that price. So your premium value will increase. When stock is going down, your premium value will keep increasing because stock is 130, but you will get 150 now because you already have a policy, you have an insurance on that. Qualcomm, you bought a 150 put, even though stock value goes to 130 or 120, you will get 150. So you might have bought a put for $1 or $2. Stock suddenly went down. That $2 can become $10, $12, $15, $20. When the stock is going down, your premium keeps increasing. So if you are bullish about a stock, you buy a call agreement. If you are bearish about a stock, you buy a put agreement. Again, just like in the previous example, there can be three cases here. If stock goes down, you bought a contract, you are at a profit, right? If stock goes up, right? Instead of going down, you thought the stock will go down, but the stock keeps on increasing. The seller, whoever sold the whoever sold the agreement to you, they will be in the profit. Or if stock, or if there is no movement, there is a sideways movement, or it is just at the same price, you are at the loss. But again, as we discussed in the last example, you know what is your risk. You have a limited risk. Whatever premium you are paying to buy that policy, that is only your risk. But as a seller, they don't know. It can be a minor damage to your home. It can be a major damage to your home. They are responsible to buy your home at the whatever your home value is. If it is a small accident, they may have to pay only $500 or $1,000 to fix that problem at your home. But if there is a big damage to your home, they have to buy that entire property or they have to put a lot of money to make all the repairs. So as a seller, you have a higher risk. As a buyer, your risk is limited to whatever premium you are paying, right? So again, right, as I mentioned, right, Qualcomm, there was a sell on 28th. Whenever you see a sell, immediately I can buy a put contract, right? I saw somewhere around 155. Immediately it will sell, right? It will send an agreement to the Telegram channel, right? I am selling this Qualcomm stock at 150. I can buy a put contract here for next week expiry or 2 weeks after that expiry. And if the stock keeps on going down and down, my premium, if I pay $2, that can become $10 here because stock went nearly $10 or $12, $15 down from 155. It keeps on going down. Right now, it started again moving up. Right, there is support. There is a support here. Stock started moving up. Suddenly on Monday morning, I may see a buy signal here. Right, immediately this algo will send a buy alert. I am buying Qualcomm at $146. I may buy a 150 call, right? If this is an upward trend, and if I see a buy, I can buy a call. If there is a sell, I can buy a put contract. And based on your risk, right? If you have a higher risk tolerance, you are okay to lose that premium, but you want to wait until if there is a sell, I want to wait until there is a buy, either, right? If you have a low risk tolerance, maybe after 10-20% your premiums increase, you can just make profit and get out of the contract. You have a higher risk tolerance, you are okay to lose that premium, but you want to wait until you see a buy. On Monday, you may see buy here. So from here to here, your premiums are getting reduced because if you got here for a $2, here it might be $10. But again, it is increasing, going up. From $10, again, it will be $6 or $7, something here when there is a buy. So you are losing some money. Losing means from wherever you got, still you are in a profit, but your unrealized profits are getting reduced. But you are okay to take that risk because it may go up here, again, it may come down. But so it is up to you whether you want to quickly book 10%, 20% and close the positions. Whenever they say, analysts say trimming, I am trimming some positions. If you have a low risk tolerance, just close it, book the profits, or you are okay to take higher risk. You can just wait until they close the entire position, right? So basically, because this market, right, as you know, because of recession fear or war fears or because of monkeypox or COVID variants or whatever it is, because of so many things, it is up to us, right? Whether you can still get stocks also, right? For example, if you see, right, we can use this algo to buy stocks, right? Let us say Soxel. We got a buy at somewhere here, $18. It went up to nearly 19, right? You got a buy here, you got a sell here. Right? If you want to use the alerts for just buying a stock, you can buy, right? You don't want that risk of losing the entire premium because you have a time limit, right? For example, right, let's go to Qualcomm, right? Because based on the chart, right, as we saw earlier, right, there was a sell, lot of selling happened on 28th, right? On 29th also, the selling continued. And then after 10-15 or so, it started moving up. Slowly, it is in the upward trend. So if it goes to certain level, it will say that, okay, now it is good to buy this stock, right? It is above the Ichimoku cloud. Generally, when it is above the cloud, the trend is bullish. So on Monday, we may see this stock moving up to, right, 146, 147, something like that. So let us say, right, I want to buy. So when you open Thinkorswim, right, this is a TDM retrades software, right, called Thinkorswim. Let us say on Monday, I get a buy call, right? You see an alert saying that, oh, I am buying 150 call for Qualcomm, right? Right, as on right pre-market price. So this is like a bid price. This is like a ask price, right? Bid means somebody is ready to buy the contract at 85 cents for one stock. That means for 100 stocks, he is ready to pay $85 to buy one contract for Qualcomm. Somebody is ready to sell at 93 cents, right? There is a buyer who want to pay 85 cents. There is a seller who want to sell at 93 cents. So if, let us say on Monday morning at 8:30 a.m., I may get it around 90 cents or something, right? A 150 call contract for 5th August. That means before 5th August 2022, if the stock goes up from this 145 to 148 or something, that means my premium will start increasing. If it keeps going up and down, my premium may not increase much. But suddenly, right, we saw there is a upward movement. It is above the cloud. It is, right, there is no resistance until nearly 148. So the stock can continue to go up to nearly 148. There is a huge possibility. Unless we hear some bad news again on Sunday night or Monday morning, the stock can go to 148. That means that when the stock is at 145, you are buying a 150 for 90 cents. If stock suddenly goes to 148, this contract value will be nearly 100%. Right? It quickly goes up to 100% within, right? If the stock moves by $3 on Monday, within 1 or 2 hours, the premium you might pay 90 cents, you may sell it for, right? You can be a buyer, you can be a seller. You are buying it approximately mid value between the bid and ask, and you can sell it nearly, if it goes up by $2-3, this will go up to nearly $2.5. So you will get nearly 150%. So instead of investing $145 on a stock, you are just investing $85. That means you are buying a contract for 100 stocks. You are saying that even though stock goes to 155, I have a right to buy the stock at $150 before 5th August. And if stock in next 1-2 days, if it goes to 150, 152, then, right, you can see how Qualcomm moved before, right? So on 27th, it moved from 151 to 155, and then there was a lot of buying, then there was a sell, and then yeah, again lot of selling happened, again it is moving up. So again, all these are good companies, right? Don't invest into penny stocks or don't buy, right? All these are good top S&P 500, S&P top 100 companies, where generally the fundamental, you don't need to worry about the fundamentals of the company, right? If these stocks are giving a buy and sell alert, unless there is a bad news, generally the chances of pump and dump is very, very less. So, right, as a buyer, if I want to buy the stock, I will go here, I will click, and then I will say if I want to buy 10 contracts, right? That means for one contract, 93 cents is for one stock, but generally one contract means 100 stocks. That means 93 cents, right? I can say it is 89 and 93. I may, right, get it for, right? You can change it to 90 or 91, right? It is like, you can bargain. Somebody is selling that, telling that he is okay to sell it at 93. Somebody is telling that he is only ready to pay 89 cents. You can say, okay, I am ready to pay 90 cents or 91 cents, and he may sell that to you, right? So the software automatically sell that contract to you. So you are a buyer and that person is a seller, right? And right, if you want to get one contract or 10 contracts based on your portfolio, you get it. And if stock moves up, then immediately, right, you are, right, the same thing, right, on Friday. Let us see WFC, right, Wells Fargo. So 29th, you can see approximately at 8:30, we got a buy signal, right? If you see SP35, so yeah, ignore CRM and buy Wells Fargo around 8:29 a.m. So it is like a 45 call. Approximately it was 14 cents, right? The pre-market price or opening price was approximately 14 cents. Then within, right, it went up 100% within 1 or 2 hours. So immediately there was a buy, it went up, nearly from $43, it went to 44.2. Again, it was showing a right lot of indicators, an early buy indicator. So even before 8:30, we gave an alert saying like this Wells Fargo seems to be moving up. Then it went so high and it went to nearly 44. So nearly 110% increased within next 1 hour, right? In the same way, right, DUK, 110 call, current market price is 106. The contract price was 60 cents. So let us see DUK. It is like 1 day before. So 28th, again, there was a pre-indicator, this blue line, blue triangle, it is at support. It gave a, that means it is showing that this stock can go up. Then immediately we got a buy and the UK went up nearly 100% plus. So we can see based on the indicators which has a higher potential, right? Again, there is always that 20% risk, but this based on, again, right, the fundamentals can always override, but with technical analysis, 75 to 80%, we can predict which stocks can move up. And if it gives a buy, there is a early buy. This blue signal, this turning into blue, that is an early buy. But this buy means there is a higher confidence. Then we can immediately enter, and then the stock, the premiums moved over 100%. So, right, DUK premiums are up by 40%. Then, so it went, right, DUK moved nearly 100%. So like that, right, that is the advantage with this algo, which will give these buy alerts. And if we can look at whether it is close to above the cloud, there is a higher potential that that stock will move high. So, right, that's what I'm telling you. You all can verify. You can do a paper trade on Monday. Qualcomm has a huge potential. There is already a early buy. You have a buy. It is above the cloud. There is a huge potential this stock can, unless there is a sudden bad news or something, this stock can move to 148 to 150 on coming Monday, right? So this is how, right? Whenever you have a buy indicator, we can buy calls. Whenever you have a sell indicator, we can buy puts. Whether you want to just take 5%, 10% and close it without waiting for the overnight or without waiting for the sell signal, it is up to you. Or until you have a sell signal, you are okay to take higher risk. You are okay to lose the premiums. You can wait until you see a buy, whatever you bought, right? For example, Tesla, right? You saw how Tesla moved. So if you just bought some call here and then just kept it, it might be 1,000, 1,500% or 2,000% on the premiums. But if stock might have went down, your premiums also can become zero. So there is always, when you take high risk, there is a potential for higher reward. But if it doesn't go as expected, there is a sudden bad news that also can lead to losses, right? So that's what we have to decide which one, right? We want to take a low risk or high risk, or you want to take, it went up by 20%, maybe sell 5 contracts. So you got your capital back. Then you can play with the remaining. Then it went another 20% up, take some profit. So it is up to you. You define your own rule book based on your risk tolerance, because everybody has a different risk tolerance. Nobody, right, can tell you what risk you have, right? So we are planning to integrate this because, right, we tried that mirror trading again, right? We had the emotions of the analysts or those, but when you have a system like this, system is telling buy, you buy it. System is telling sell, you sell it. Most of the time what happens in trading is when you sell something, then that keeps going up. When you hold it, that keeps going down. Because that emotions play, right? Even for analysts, experienced people, for everyone, those emotions, especially when you invest huge money, that things can happen, right? That's what happened with mirror trading or funds. So these type of systems will help you to just follow the system, right? Right? As an analyst, they may see that, oh, I got a buy. Is it at a good support level? Okay, it is at close to a good support level. Is it above the cloud? Yeah, it is above the cloud. Okay, then I can give a alert for a call, right? It is at 780. Let me give a 800 call or 810 call. So your premiums will be cheaper. And that 810 went to 900. So you saw, right, where we made 250, 300% on Tesla calls on some of the runners. So that's how, right, we can invest less amount based on these alerts. You can invest, right? You are not buying a stock, you have to invest huge money. But with an option contract, you are only investing $100, $200, $300 instead of thousands of dollars. So your return of invest, right? If you bought Tesla stock from 800 to 900, it is like approximately 10 to 12%. Whereas here, if you bought a call contract and kept it, it might, right, give you 200, 300%, or it might have given you that within the 2 days. So again, right? So that is the advantage with options where you have a higher risk because you have a time decay. If it doesn't happen within that 1 week, if you are buying a August 5th contract, and if Qualcomm is not moving by 5th August, whatever premium I paid, that will become zero. But if you want to, like, you can say that, oh, let me buy 12th August, then your premiums will be high. For here 150, you are paying 90 cents. If you are taking more time, that means you are entering an agreement where you have a time up to 2 weeks for the stock to go up. Then you are paying nearly double the money. So based on, again, lot of factors, right, called Greeks and open interest, volume, there are a lot of things, but I want to cover the fundamentals today to explain what are options, right, what are calls, what are puts, right. If you see a sell, immediately, right, all this side is calls, all this side is puts. Let us say on Tesla, right, it moved so much. Let me tell you, right, there is a stock which can go down on Monday called AMT, right, another big company. So on 28th, it gave a buy signal. It went up, went up, went up, went up. And now, right, it nearly from $256, it went to $274, right, nearly $18 move from Monday to Thursday to Friday. And now it is coming down the cloud. There is a early sell, right? This is red, it is turned into red. So there is a possibility that AMT will come down to approximately $267, from 270 to 67. If you buy, for example, you see a sell here, it moves down by $2-3, your premiums will be up by, right? If you are buying a put contract, your premiums will be up by nearly 40-50% on Monday. So AMT, right? Just watching the paper trade, right? Don't take any trades, but right, once you see some trades, then you will get more confidence, right? For example, for 19th August, I may buy, right, let us say the 270 put, right? If I am bullish, I will be buying it calls. If I am bearish, I will be buying the puts. I will buy a put for 270 or 260, and stocks goes down, your premiums will keep on increasing. If it goes down more and more without any upward movement, your premiums will become 100-200% on the same day. So that is what. So again, this, when you, so as of now, there is an early sell, there is a downward movement, it is down to the cloud. If it comes down a little bit, then you may see a sell agreement and you may see stock going down by $4-5. And if the support doesn't hold, it may go further down, right? So again, based on, right, how it moved. So there was a buy, it went up and then it came down. Again, there was a buy on 28th, it went up so high, right? It is always, stock market is always, people will be buying and selling. So they bought here, they took some, they are taking profits. So again, the stock is coming down. Again, it will come down, it will come to a support. Again, people will start buying. Again, it will go up. So whenever you see a buy a call. Whenever you see a sell, or right, UC means you don't need to have an algo, because if you have to see this chart, you can only see one chart. But we already have hundreds of stocks tracking here, and whenever it sees something, it immediately, right, it gives that right for futures or options, it immediately gives that, okay, this stock Nvidia is started going down, Shop is started going down. Then immediately I buy a put, you can make some 20%, 30% like that, right? So I am selling Netflix, I am selling Roadblocks, I am selling Shopify. So this alerts, so our analysts will immediately look at those. They will see things are looking good, then they will immediately alert in one of these channels, right? For example, Casey is looking into those. He gave a Tesla 900 call, Tesla 810 call, right? BA 160 call. So if you see, right, Xom, so Shop 34.5 put, right? If you go there and see Shop, I am selling Friday, I am selling ticker Shopify. So you have an alert which immediately moved 20-25% quickly. So we have, right, various with for options, we have, right, earlier we used to have all the analysts in one channel, but based on request, and we also thought that is a reasonable request because, right, with the algo, it is much more easy for us, right? We saw that DUK is moving up. Immediately we gave a call. We saw CRM is, there is a buy signal. We gave a call. WFC, we saw that there is a buy. We gave a, so the number of alerts will be more. When you see a buy, you buy a call. When you see a put, you can buy a put. And so because the alerts are increasing, we have separate channels, right? To KC, we have a main channel for KC. HK, we have a separate channel. VC, we have a separate channel. So like that, so not all the analysts are using the algo as of now. KC and HK, they are tracking the algo also and giving. So they do one more validation, right? Algo is giving, they will see a few more factors and then immediately give the alerts. And then there is a good potential or good possibility. So you might be seeing more trades and you don't need to take each and every trade. If you are busy, if you are free during lunchtime, if you get some alert, you take those. If you are free between 8:30 to 9:30, you take 1 or 2 alerts. So you don't need to think like, oh, I don't have time to take so many alerts. Even one alert will make you that monthly amount, whatever you're paying. And right, we want to start using this for our fund and for, then we want to integrate this for mirror trading also, so that instead of analysts doing it, whenever there is a buy, immediately the software will buy stocks or software will buy closer calls or closer, right? If there is a sell, software will buy put. So we are working on that, right? We are testing based on the previous experience, right? For mirror trading, we had technical glitches and which right caused losses to many of our members. So we are making sure that we do rigorous testing. But until that time, if you want to take advantage of those things, you can be part of the option channels or stocks channels, and you can be right. You can be getting the right. Analysts are looking at those things, immediately giving those alerts. So just 2 days will cover your monthly. Again, you decide about your risk tolerance. Analyst may have a huge money. KC may put $10,000 for every trade. Even though he loses 1 or 2 trades, for him it may not matter much. But for you, that might be a huge money. So you may want to, once your premiums are up by 10-20%, you may want to just come out, right? So analysts are giving a direction whether the stock will move up or move down. You buy it, and based on your risk tolerance, you can close the positions, right? Because his risk tolerance might be complete. As I told you, right? There is one support. There is one support. There is a resistance here, but stock went up more than that. There is a resistance here. Stock broke that resistance. So analyst will only know that, okay, from here it can go up to here. Okay, it broke this, then it can go to here. It broke this, it can go to here. But they don't know that stock can directly go from 250 to 275 or something, right? They look at support, resistance levels, Fibonacci, various things, and they can give, and they will be trimming at various levels. And if they see it is coming down, they may close the positions. Or if they see it is going up, they may hold the positions. So in the same way, you decide what is your risk tolerance, and you can trade based on your risk tolerance, right? So with that, again, I don't want to take a lot of time. I hope everyone got a clarity on what are, right? What are option contracts? It is basically 2 types. We have why we do options. One, you have a low investment. If you are bullish about a stock, you are speculating, you're guessing whether stock will go up or go down, you can make money. If you think stock will go up, you buy a call. If you think stock will go down, you buy a put. Or you have a stocks in your account, even to hedge those. So even stock goes down, because you have insurance, you can, right, when you're buying some stocks, get a put for after 6 months or something. If you think there is a ration, the stocks can go down, you are paying another 5%, 10% in the form of a put, but your value is protected, right? So we discussed all these things, and we discussed how this algo is helping us to gain, right, to enter into a lot of positions and make some 80-85% success recently. Because as an analyst, only they can look at 1 or 2 stocks at a time. But this algo is giving, oh, this CRM is going up, Duke is going up, or this stock is CVNA is going up, RBLX is going up. The algo is scanning all those things. Whenever they are at buy alert, it is sending a buy. Whenever those stocks are going to sell, it is sending a sell. Then analysts are doing one more round of confirmation, and they are giving alerts so that we can take the trades, and based on our risk tolerance, we can close, or we can take 20-30 quick profits, or we can trim some positions, hold some of them for next day. It is right. And you always start with paper trading. Take some time to understand the trades, understand how to quickly enter, exit. Right, we will be taking some training sessions on how to how to do that buy and sell with a trading stop loss, so that you can quickly, you don't need to manually do buy and sell automatically. When you do buy, automatically you will have, if it goes up by 20%, it will take profits, or if it goes down by 20%, it will close the contracts. We'll be doing more sessions on those things. But hope today's session was helpful, where you understood what are calls, what are puts, and how you can make money even though it is a chart or the market stocks are going down. You can buy puts and you can make money. If stocks are going up, you can buy calls and make money. And what is the risk of selling calls or selling puts? We discussed all those things, and how this algo will help us. Right? Again, algo, if the stock is not moving like this, or if it is just sideways, right? Those days, it may not give us the problem, right? If stock is not either moving up or moving down, then if you are buying a call or put, then your premiums might go down. So that is the only risk with, but generally, because these are top stocks, S&P top 100 stocks, generally either they move up or they move down on a day-to-day basis, right? So with that, let me start the quiz. It will be a 15 to 20 minute quiz, and winners will get some prizes, Amazon gift cards. So I will share a link in the chat window. You can use either your phone or you can use your laptop, and you can enter into the quiz. Yeah, there are a few questions before starting the quiz. What is ITM and OTM? That means in the money. For example, you bought a Tesla 900 stock, and your Tesla stock moved up to your strike price, and the stock price are same. That means it is in the money. OTM means out of the money. That means stock price is 890, but you are buying a 920 call or something, right? That is like it is out. OTM, and we have an account challenge going on, where one of the analysts is running a 5K to 10K challenge. That means you start with your account with 5K. Every day he gives trades like, okay, I'm buying 2 contracts of this. I'm buying 3 contracts. So he will also specify how many contracts he is buying, how many he's doing. He's also doing at the same time with you. So the challenge is to make that 5K to 10K within 4 to 6 weeks. So that is going on. And first week, they already achieved 25%. From 5K to into 6,250 or 6,350 or something. But you can still join and analyst AAA. So there is a channel called. So once you subscribe using options _PREM_bot, you will be part of all the channels, and you don't need to take each and every trades. If you like KC trades, just follow KC. You like MG trades, because we will be sharing these reports, you can see who is giving what, and For example, Casey gives Tesla, Nvidia, AMD. The premiums might be little high. You may not have a bigger account. Maybe you can go with MG, his premiums are small, or AA, his premiums are small, or VC, right? Or HK. You can, so for 1 hour, right, maybe a week, you just look around, right? What is happening, how they are giving trades, how, right, who is making bigger profits, and then, right, practice for some time, and then once you get the feel of it, then start using your real money, right? Otherwise, if we are in a fear of missing out and start before understanding things, we may lose, and then we may lose interest, and we may stop trading, thinking that, oh, it is not working out for me. And we don't need to take all the endless trades or all the trades. Even if we take one trade, that is enough. If we can make $100 in the first half an hour, that is good enough. So algo channel, as of now, right, we are right, 80%, 90% of testing is done for analysts as of now. It is because there will be hundreds of stocks you'll be getting, buy, sell, all those things. In future, we want to open for our members also, where somebody who is a full-time trader, they can just look at the alerts, and if they have some knowledge, they can look at the charts and they can take whatever trades they want. We want to, but we are doing 80% of testing is done. It is working good. Either market is bullish or bearish, the algo is giving great results, right? But if it is just choppy, it is moving sideways, stocks are not moving at all, then those days it might be, we might be losing some money, right? But again, you have a buy, sell immediately. So your losses are minimal because you are just following the system without assuming that, oh, it will come down or come up. You have a system which is looking all those things and telling you. So if you are already a member, if you are not seeing all the channels, you can just send a message on options_premium_bot. We will look at your subscription and send a link. We'll add you to the other channels. So again, shorting a stock and buying a put. So shorting is you are selling a stock. Again, right? Buying a put, your risk is limited. You shorted, for example, you shorted Tesla at 900, assuming that Tesla will go down. Suddenly Tesla went to 1200. You have a huge risk of $300 for every stock. But when you are buying a put, your risk is limited only to the premium. So always buying a put is low risk compared to shorting a stock. You don't need to buy 10 contracts for each trade. It is up to you based on your portfolio, right? Instead of the number of contracts, you always divide based on your portfolio, right? Let us say I want to invest $250 on every trade. So if, let us say $300, if the premium is $1, you may buy 3 contracts. If premium is 1.5, you may buy 2 contracts. If premium is $3, you may buy only 1 contract. Like that, based on your portfolio, you can put some limit, right? Otherwise, if you buy 10 contracts on a Tesla, suddenly it goes down. If you may lose huge, right? Whereas on all other 9 small ones, you may make profits, but one Tesla contract, if you lose, so that position sizing is important, or right, where you divide based on the money, but not based on it. I'll buy 10 contracts for everything, or based on the premium value, you say that, okay, I want to spend $300 or $500 for every ticker. To buy a put, you don't need to have any underlying shares. Again, you have secured puts where you need to have 100 stocks, but it is not mandatory. But your account, that much money will be, right? That brokerage platform will be holding that much money. If you are shorting you are selling a put. Right. Yeah, I think yeah, those are the questions. So please use this link. Again, sell call or sell put, there is a risk involved, because if stock goes down, you can make money, but if stock goes up, suddenly if there is a V-shaped recovery and stock goes up so high, you have a huge risk. So yeah, again, better to be on the buy a call or buy a put in this market, because suddenly if there is a recovery and if all stocks keep moving up, right? Last 6 months, maybe sell was a good because stocks were just moving up and down. But it seems, right, there is a possibility that this bull trend may continue. A lot of people expected earnings for all the major companies will be down, but many of the companies gave good earnings. So market suddenly started in the bullish movement. So yeah, better don't do a lot of sell calls or sell puts for something. Again, I am sending the link to everyone. Please click on that. Again, right, how to place trades on Fidelity or Thinkorswim. Again, if you go to YouTube, there are a lot of videos. We can do some sessions in the upcoming weeks on how to place the trades. But because, yeah, already there's a lot of information there. I'm not covering that part. But right, as I told you, just you go here. If you want to buy a call, click on the buy, and then just how many contracts you want, and then confirm and send. If you want to buy a put, right, what is the expiration date? You have 19th August or 16th. All these are monthly expiries. You can buy those things. You can do confirm and send. Right? And there are a lot of videos in YouTube on how to use, because some members use Thinkorswim, some use TD Ameritrade, some use Interactive Broker, some use Fidelity. So tool specifics, you better use the right. Already your tool, the tool website will have a lot of videos. On YouTube, if you go and say Fidelity how to enter trades, you will have that information. Oh, sorry, I think, I'll give 2 minutes for everyone to log in to the website, and then I will start the quiz. So there is a link in the chat window. Please click on the link, enter your details, enter the right email so that we can send the Amazon gift cards to the winners. Right. Yeah. Let us start the quiz. At the end of every question, we can see like who is at the top. Right. I think 46 members answered it right. OTC stock, right? Over the counter stocks, right? Penny stocks, which are generally below $5, right? Most of them are OTC. So these are dangerous. Sometimes they can make huge money or suddenly they can be dumped. So better, right? If you enter at the earliest. Otherwise, it is a big risk. So Tapan answered it quickly compared to everyone else. So Tapan Mahendran is at the next place. I don't know Kishore, some other Kishore. It's not me. So blue chip stocks are the right all these top company stocks, right? Like Disney, AT&T. Generally, they are consistently profitable with a dividend payment. Right? The growth stocks they use the earnings for reinvestment, whereas blue chip like value stocks they generally pay dividends. Tapan Pradeep is at 2. Mahendran is at 3. Tapan is at 4. Great, good going. All the best, everyone. Let's move to the next one. Right? Yeah. There are dividend companies which pay dividends. So not only buying low, selling high, you can also make money in stocks by buying the dividend stocks. So nearly 49, which is good that 49 members answered it right. Based on how quickly you answer, you get the points. So Mahendran is at the top place, and the Pradeep Lakshmana is at the top 2. Tapan is at 4. We don't know which Kishore, but so if you answer quickly, you get more points. It is Dow Jones. DJA is Dow Jones. Which company is on that index? Yeah, it is Disney. Disney is on the Dow Jones, not the other ones. AP Kant, Rajiv, Vijit Gupta, they came to the top 3 now. Which type of stocks you want to short sell? Right? Shorting is where you are selling at a higher price and buying later at a lower price. Even though you don't possess the stock, you can short them. But again, comes with a high risk. Right. 48 members answered it right. So whichever stocks, right? Especially we have a stocks day trading channel, right? There are some stocks which gets halted. You right, those stocks suddenly go up from $5 to $20. If you short those stocks, again next day they will come back to $4 or $5. So those are like pump and dump stocks which are good for shorting. You can short them and you can make money on those stocks. Right? Generally, these penny stocks suddenly they go up, and after 2 3 days they go down. So such type of stocks are good for shorting. Right? Not the big company stocks are risky. Don't short Tesla. Don't short right Nvidia, AMD, Google. They are good companies. They can on any day they can suddenly go up high. Next one. Who are the founders for the Dojo index? Yeah, that's good. We have a lot of members who got a lot of right. There is definitely very difficult question. Charles Doe, everybody can expect, but Edward Jones. So right, Doe Jones. So the index name itself have Doe and Jones. Right, that is the clue. Good that 37 members answered it right. Yeah, there is a tough competition. Good, good going, everyone. CSCO stands for which company stock? Right, it is Cisco. Good, 44 members answered it right. Right, they are very close. So I know some of you might got confused with Cisco. Rajiv moved to the top one, and Pradeep top two, Vijay at top three. The right answer is mutual funds. I think many have perfect index, but Pradeep is a top one now. Vijay top two, top one, top three. It's good. Majority of them answered it right. Debris empty. Right? Leaps are instead of buying the next weekly or next monthly. For example, when Tesla is at 650, right? You may have a feeling that Tesla within next 1 year it will go to $1,000 again. You can buy $1,000 contract when it is at 650. Now today, within last 2 weeks, it moved $150 or $200. So leaps are like long-term option contracts for next year. After 1 year, 2 years, you can buy the contracts, and suddenly those stocks go up. You make a good profits. So when market is down, there is a good time to buy such type of leaps again. Right, this week again it is up, but again if market goes down, you can always buy leaps for Tesla, AMD, Nvidia, because all these are good companies, right? Fundamentally, they are very strong. They will come back. If not in a month or 2 months, 3 months, in 6 months, they'll come back. Good. 99% answered it right. So we already discussed during the call bearish, bullish. I know, right? Some of you know the answers, but sometimes you get confused while reading, and because there is a score based on the speed, some of you might quickly put that. So, and we will be having these type of contests in future also on various topics. Right? Yeah, we all know about margin account and right, when you buy some penny stocks, you may not have sellers or buyers. So yeah, that is a liquid market. And right? It is both. You can borrow, even though you don't have the stocks, you can sell them. And right, in bear market, there is a good strategy to make money. Many of us, right, try to be away from the market thinking that it is a bear market, but you can also short, right, especially low cap stocks, mid cap stocks. You can short them, and those stocks go down, you can make profits. So it is both A and B. Consolidated addition is the right answer for you. Right? Again, it's the market close price, so that means 3 p.m. Central. Good job, everyone. Five. One correct answer can bring others into the top five, so don't lose hope. Right? New York Exchange is the oldest exchange generally for all the value stocks, whereas all the growth stocks, all the technology stocks, all those are listed on the Nasdaq. Advanced micro devices. Good, 46 answer it right. Yeah, it is zone. And yeah, we may see more upward movement on Monday for zone. It is most close to 225. Right, all the other three are brokerage platforms: Thinkers, Swimmable, Interactive Brokers. Tesla is a stock. So, I think last three questions. Right, yeah. Everybody answered it right. Facebook recently the tag changed to Meta. It's 3 p.m. to 7 p.m. Central, which is the post market, right? Yeah, still, you can do trading even from 3 to 7, right? Not for options, but minimum for stocks. You can buy, you can sell, or even in the pre market from 4 a.m. itself, you can do trading because many of you might be working. You can even come up at 5. So there won't be much volume, but still, if you think like, oh, Tesla is moving up, let me buy some stocks, you can always do that. The last question. Right. Yeah, Thinkorswim is one of the most commonly used trading platforms, right, by TD Trade. So let's see who are the final winners. I hope you all had fun. You learned some new terms, new things as part of this session, and we'll continue to have more of these on stocks, on sports, right, on cricket, on movies, Bollywood movies. We'll be doing more of this so we can have fun and learning together. Rajiv is the winner with 966 points, and Srikanth with second place, and Pradeep Garu at third place, Kapan at fourth, Rishi at fifth. Congrats to everyone who participated, because participation itself is a winning, and the top three winners will receive Amazon gift cards. So please send me your email on. You can use any of the bots, right? Options bot or stocks bot, and right while registering already, you might have entered it, but if not, send me your email, and I'll be sending Amazon gift cards to the top three winners. And we'll continue to do these sessions and also these fun quiz contests. So yeah, share with all your friends and join with family, and so you can learn and have fun. And good night, everyone. Thank you for joining this evening, and wish you all the best. Have a great rest of the weekend and have a great week.